Hello, everyone, and welcome to Jim Dalton's presentation on the Intensive Preparation Fast Track webinar, Part 2. It's May 27th, 2015, and we're looking at 4:31 Eastern. We'll go till about 6 p.m. Eastern. This webinar is being recorded. Please enter in your questions. We'll get to as many as we can. And great to see you all here. So thanks after a day of trading for coming out and hearing what Jim has to share. It's great to see you, and we appreciate it. This webinar will be posted probably not until about 9 p.m. Eastern this evening. Also, while we're on it, before Jim rolls into his presentation, because we're going to go at it pretty hard once he starts, we wanted to let you know about a new market profile platform. We've yet to try it, but I've worked with him going over it, and I'll be getting it this week. And if you can see my browser here, I just put it on the resources, market profile platforms. It's called Market Map, and it's pretty neat in terms of it marks poor highs, poor lows, prominent points of control. He's added the 45 line in the last week. It plots them on daily bars as well. He's primarily a crude oil trader, and he's been a really good student of Jim's and learned these things, and also has the gift of coding that he's created this software. So we have not used it yet, but it looks pretty neat. It's only because of my time that I haven't been able to get into it. But I wanted to let people know about it because I know there's people out there still looking for market profile solutions, and that's not obviously the intent of this webinar. But I know people are out there, and we all have different budgets, we all have different tastes, and whatever works for you is the best solution. So this is one more we just added last week. If you want to check it out, it's called Market Map. And with that, I will thank everyone for being here, and I'm looking forward to your questions. We've had some fabulous questions over the last 6 weeks, so please keep them coming. And with that, I will turn it over to Jim Dalton. Hey, Jim.
Hi, thank you, Julia. Okay, this is the second part of the preparation for the intensive. We will get to today's markets. I know there has to be a lot of questions about today's market, and we will definitely get there. But where I want to start, hold on, I guess we've got to show my screen. Let me know when you, Julia, are you there? Okay, I'm hoping you all can.
There you go. Yeah, you're
cool.
Cool.
See my screen now? Okay.
Thanks.
Okay, Julia sent out a revised fast track document for those registered for the intensive. You will notice that one of the very first things that we start with on the fast track is when markets open in or out of balance. And the first thing I want to cover today is I'm going to get to yesterday's opening, which was out of balance. But leading up to that, I want to spend a considerable amount of time and take a considerable number of questions regarding the market. How do you know that a market is getting too long or too short? We're going to see this explanation that I'm going to go through first. Then we're going to see it in a whole different perspective from yesterday, and then we're going to relate it to today's short covering rally. Okay, so the first thing, this is in preparation for understanding what took place yesterday. You are looking at a market. I started this chart with 511. There's obviously days below it that was trading. But you'll see that on 511 and then 512, the market started higher. Notice on 512, there's a POC that's not been revisited, and that would be a prominent or very prominent point of control that has not been revisited. So that's always a piece of information that we carry forward. You will notice on 513, we have a poor low that had not yet been repaired. That's another piece of information that's carried forward. You notice the entire shape of the 13th is, I don't know if it's the 13th or 14th, I think it's the 13th. Very strange. Poor low. You see how anomalous it is in the middle. Then you get an extension later in the session. I think what happened in here, I've said before, I believe there's collusion in the markets, and I think the trading short-term traders that have some pretty good sized capital decided to go after the all-time highs and get the stops above that. So the market started off, and you see it goes, and the all-time high was right around the 2119 level. We get the all-time high, but in that process, what I really want to point out is, have you understand the process of getting to the all-time high, the point of control not revisited, the poor low, the anomalous area right in here. The low on this day, which is probably the 14th, it's technically a good low because there's two single prints, but it's 4 wide right above it, so it's certainly not a very good day. And we have, it's not a good low, not really good. We have a prominent POC that's not been revisited from that day. If you take all of this information and start to add it together, that's what we call, looking at something, having an exponential view. And this is where I would write that I thought that the risk of being long in the market was very high. You'll also see comments that I write that say, just because I think the risk of being long is very high, that doesn't mean it's going to be corrected right now. And part of the reason for this is you get momentum traders out there. And if you remember, I've described momentum trading for a long time, and I said you want to be with the momentum traders when they first get started. At the end of the momentum trading, you don't want to be there. The end of the momentum trading, it's very much like being able to bet on a horse race till 1 foot before the horses cross the finish line. All the money will go there. The risk and return will be horrible. What you'll make pennies. Your risk is absolute. It's just not a very good situation. So first of all, keep in mind the information that we have carried forward. Now, this can be very frustrating to traders because when they see this information, they may want to fade this market too early. Remember, the saving grace is always value. Value is clearly higher on this day. Value is overlapping to higher. By trading value, it will help you not to get caught up in some of this. Okay, now I'm going to go through this pretty fast. And now I've just talked about the points that were on the last slide. Now we saw the days leading up to the 2119 level, which was the approximate all-time high. We've said it so many times, once you go through a level, that then becomes support. That level becomes support. The market came down, and we went up. We made a new high. Now remember, the all-time high was made in the electronic market. It was not made during the pit session hours. You're going to see that again. That's also information we carry forward. A couple days after the market made the all-time high, you see it came down to almost exactly at the old high, the 2119 level. It's so mechanical. You see again, it happens the next day. It opens down there, and then you get a short covering rally. That's not good structure, not good structure at all. But this is what mechanically what the market is doing. They're buying when there's nothing else going on. The traders are buying exactly at the previous high at a very mechanical level. And when we buy at those mechanical levels, that is a sign of weakness. It doesn't mean it's not going higher, but when they buy mechanical levels, it tells you it's the weakest. It's the day time frame in short-term traders. They are the most fickle, and they can turn on you the fastest. So this is the setup. This is the setup, what the market looked like coming up to yesterday's lower gap. Now, you'll remember when you saw the research report, the recap and preparation report, as well as the morning report, we identified 2119 as a go, no-go level. And the focus was on, we had a 3-day balance, and the focus was on the low of this 3-day balance. It was not focused on the gap. We did gap. It wasn't focused on the small inside day. It was focused on the 3-day balance. We opened yesterday morning at about 21.1850, traded a little lower. We looked a single tick above the 21.19 level, and that one single tick above it, and the market was on the way to the downside. At that point in time, remember all of the points that we made coming up to setting the stage for yesterday's breaks. We talked about the poor lows. We talked about the point of control that hadn't been revisited. We talked about, the lack of structure, all of those things. Notice that how many, you'll see as we go through this, how many of them got corrected yesterday. Psychologically, traders yesterday morning, I'm going to guess, even though we had the number out there, where the no-go low, the go, no-go level, and it was a clear number. There wasn't anything ambiguous about it, and we look one single tick above it, and the market was off to the downside. A lot of times, traders couldn't pull the trigger, at least a couple I've talked to, well, because they thought they missed a trade, it was already down so far, etc. You have to understand what has built up in all this inventory and this long inventory that's built up, to understand that once we start trading down below the 21.19 level, all of this late buying that took place after they made the new highs, and there was never any real lift. Remember, all of this trading is going to be underwater. So instead of being afraid of, oh my golly, look how far this is opening down relative to Friday, I can't chase this now, that is absolutely a very safe trade. The odds are so good. That's an asymmetric opportunity with you. Now, I want to make one more point before we open up for questions, just what I have talked about so far. We've got a lot more to cover, but just what I've talked about so far, you want to start carrying forward new information. One of the things to start carrying forward was that the mechanical nature of yesterday's break going one single tick above the reference level. How mechanical is that? That is a piece of information you start carrying forward, and it's also a piece of information that suggests that there may not be as much to the downside as price might initially indicate. Okay, before we go to the next slide, Julia, what questions do we have just on what I have covered so far?
Okay, thank you, Jim. On today's action,
no, I'm not talking about today. I only want to take questions up to what we have covered so far today.
Okay, it comes back to being too short. Let me just ask it and see. Just follow it along if you would. How did the market go from being too long all last week, as discussed in the recap and prep report last night, to all of a sudden 20 points too short coming into today? I guess I would have expected a little more follow through before getting itself too short today.
I don't want to talk about that yet, because I'm going to talk about that. I'm going to talk about that. Remember, I set up the first piece of information about today's rally by pointing out that we looked just a single tick above the reference before we broke yesterday. That is a mechanical break. Okay, so that we're going to talk about yesterday, but that's the first piece of information. Also, remember, I said early on that the all-time high was made in the electronic market, and we have written over and over again, and so far it's never left us standing out there in the naked when the waves went out. It's always come back. Sometimes it's been a few weeks or so, but that's always a piece of information to carry forward. There's been no real completion to this market. Okay, so
Yes.
questions regarding was the market setting up for yesterday's break? Then the next thing we're going to do is talk about yesterday.
Okay, and I remember during the fall intensive when we had that 10% liquidating break, I think it was October 16th, and we still had those poor highs out there, and wouldn't you know, it came rallying back up over 100 S&P points, but it did come out and take out those highs. So we have seen this over the years as we've been scratching at new all-time highs over and over again. Okay, did you wait for the market to break the overnight low as well as before to put the trade on yesterday? Did you wait for it to break outside of the overnight low, Jim? Maybe you could go to your live window trader screen.
Yeah. Well,
it's more.
Julia was on a call. We were on with an institutional client on Sunday, and Juliet, would you share the conversation, my side of the conversation on Sunday?
Will you believe that the hedge funds really just got it? They got together and they knew they could gun for the stops, and they got them. And it was interesting.
No, what my position was, what my bias was coming into yesterday.
Oh, well then, yeah, you had gone home long puts, and Jim had said, the client had said, yeah, but you took a little, you got your premium, the time premium, you lose over the weekend, and you had just opted to do it that way. I think you added to it on Monday, or maybe it was Monday night for Memorial Day, but yeah, because you just felt like the structure at the top was very poor and we had no lift. We usually get a little holiday or pre-holiday, little follow through from the all-time high being hit, and we didn't have it. So, yeah, when we opened, you were ready and locked and loaded to bag it.
I thought all this information, remember, we introduced the concept of the tactical trades not too long ago. So we introduced that, and the thing that really made my decision, it's a small thing, but these lows didn't appear to be any good to me. But the final decision.
You might want to just go to Window Trader. It might be easier.
The final decision was, if you look at Friday's market, so many times when a market's been up prior to these holiday weekends, we normally see the market trade higher.
Yeah.
And my comment was that the market did not trade higher on Friday. And not trading higher on Friday was the final thing. I said, well, we don't have that underlying follow-through strength and enthusiasm in the market. And that's what tipped me over to go home along puts coming into the weekend, or coming into Tuesday. So I was already set up for it. Now the question is, did I add to that position? And the answer is yes, immediately. And no, I wasn't waiting. I wasn't waiting to take out the overnight low. And that's what I'm trying to get to here is, when you look at all this information, and once you get down here, yes, it's a go no go level. It's a go no go level, but there's sometimes you just take the chance, and as soon as it tagged up here, and there's just nothing, and it just hit click, and it's gone, and it's an asymmetric opportunity. Too many times we talk ourselves out of trades that should be done. But my point is, if you didn't understand the market's potential to break coming up to yesterday's break in the morning, then you're not prepared, mentally prepared, to go with that trade. If you haven't done the homework, you haven't seen how this market came down exactly to this level twice. What is it? What would you tell? Would we say this is weak or strong? You've heard this terminology from us. This has got to be weak when it comes down here twice, exactly to that point. This This just tells me there's no real buying in here. Long-term money's not going to wait till you get a tick down below this or tick at this level to buy it. So I got a pretty good idea that I've got weak money coming up here. I've got a lot of weak money up here, and the conditions appear to be right to give me an asymmetric opportunity, and that risk appeared to be worth taking. Sometimes we find too many reasons not to do trades. I'm sorry, go ahead.
Beg your pardon. Did Monday's holiday trading give you any additional clues?
Matter of fact, it did, because overnight it also came down to that level, and it went back up. You had a little bit of volatility there, but there was no real strength from overseas. There was no real underlying strength in the market.
Let me knock out a few questions here. Are all the previous references from May 11th to the 25th, they get erased, or are they carried forward in light of the 26th? Any repaired structure, Eric, once it's repaired, it's off the board, because we'd be carrying forward. It would get so, difficult to manage it. They're repaired, they're done.
That's right.
So we're pulled there.
It's very important. One of the mistakes traders make is trying to accumulate too much information. Once something's done, it's out of my references, because I'm always trying to bring it down to what is most important.
Jim, can you just go to your window trader while we take these questions on it, because that's so small. Just to look at that blue chart from yesterday. Okay, maybe close your time templates. So we have a question. No, I'm just letting you know ahead of time. So we have a question. When it looked above the 2119 level, which everyone can see from the reports, the morning report yesterday and the evening report that came out Saturday night, how long do you wait below 2119 before we know or for sure the market is going down? So if you
you are never going to know for sure. Okay? If you know for sure, you're not going to have an opportunity.
You have to recognize too that you can see the opening, to make it just a little bigger with that green dot. We know we're in a gap situation. We know we go with all gaps that aren't filled relatively quickly. It got one tick above the 2119 level, and I know this takes experience, but it looked above it. Nothing there, gap isn't filled, we're going with, and you just click, get in. Where do I put my stop? Probably back inside Monday's range, might even have to be back inside Friday's low, but go ahead.
I have it in Friday's range, but
yeah.
You don't have to wait for the stop to get hit. Remember that. That's a stop's a fail safe thing, but if you understand the condition of the market coming into the day, that is an easier trade to do. That is where you get the confidence to do the trade. Understand the importance of the 2119 level. Understand how many times it's been there. Poor low along here. We had another poor low down here. That is the kind of stuff that gives you the confidence to make the move and do these trades. And other people yesterday, I talked that, well, it's too far away from Friday. I can't chase it. Those are the markets that you do chase. Okay.
And we were in a 3-day balance there too. I mean, it had all the makings. Yep. If you slide it down a little, they can see that. It's not the easiest trade. Obviously, you can't fade an edge. You got to just go with. You don't know if it's going to pop back behind you, and you're out on a limb. But it's a gap situation, and that's what we do with the gap rule. You got to think asymmetric. Think asymmetric. So, well, that's down so far, I could take a loss. Well, yes, you could take a loss, but the opportunity to know that once we get down below the 2119 level, all of this trading up here, all of these people are underwater. All of these traders that particularly bought this, they're all underwater. And you're going to get liquidation. We're going to see the same thing today. So when we go on, we're going to talk about the same concept, and you're going to see it in action again today.
Okay. Should
Okay,
I go
great.
on, or we got any more
Well, we got a few
questions?
more questions. How do you handle the holiday like Monday? Do you dismiss it or do you use it?
I dismissed it.
Okay. And what would you say for a prominent POC, Jim? In the S&Ps, we get 13 letters, I think it is, for the session. When you say very prominent or a
I,
prominent point of control, we're talking around 8 or 9,
it'll
maybe.
stick out. I don't know the exact answer. Okay. I'm always asked that question. But if you, as you start to observe over time, you'll begin to, without being mechanical about it, you'll see that there isn't a prominent point of control here.
There is
When you
on
get
the
over
next
here,
day. Yep.
this one is very prominent, very prominent, very prominent. Prominent to very prominent. It's one of those things you learn by observation. Give you the concept, and each market trades a little different times, so it will be different. Crude isn't open as long, and corn and beans aren't open as long. The S&Ps are open a long time. But again, it's not a mechanical number, but you'll know from observation as you go on. And it's just a progression. You know this is not, and you get over here, you say, well, this is. And that's really, there's still artwork involved in all the things that we do in here. And it's the artwork that gives you the opportunity. That's really what I'm trying to get at. Okay, other questions?
Okay, do you consider yesterday's low as poor? If you make that a little larger, Jim, and we can look at it, absolutely. It's a double wide.
Absolutely. Yeah.
It doesn't
Yeah.
have, you need 2 ticks of excess on a profile.
Yeah.
So if you just look at it, Jim, so they can.
But I'm not to
Yeah.
yesterday. I don't want to talk about yesterday yet. I want to make sure
He's just
that
asking if it was a poor low.
of course
So,
it was. I just want to
okay.
talk about there's a whole lot of stuff to talk about yesterday, how yesterday set us up for today. But most important to me now is when we get ready to start the intensive, that's why we put out the fast track document. We have those days when we open in balance. We have those days when we open out of balance. The biggest opportunities come when we open out of balance, which was yesterday. But again, if you understand what occurred prior to opening out of balance, you will have a much better sense should you go with that out of balance trade or not. So I'm trying to bring 2 things together here. The first question that we're always asked, how do you know if a market's too long or too short? Okay, and again, you're never positive, but when we looked at this market going up to yesterday, we got a pretty good idea. When I say it's too long, the information I'm looking at poor lows, prominent points of control that haven't been revisited. I'm looking at the market coming mechanically back to the 2119 level, poor low from this bounce, bounced exactly off of here. I got a pretty good idea that this is fairly weak and fairly weak longs in here. Okay? So, I mean, there's history. It's the history. This is the continuity that helps you have a little bit of ability to go with the trade, to be looking for it and go with it when it arrives. Okay?
Right. You're not just walking in blind and, oh gosh, gap open. What do? I can't chase it. You really, it's a process. That's why a narrative or our end of day preparation is really just a continuation over the days. You might move references, erase them, but it's kind of like I'm doing my narrative. Sometimes Jim's writing the report sometimes at 1 or 2 o'clock. It's not something that just happens, compartmentalized at the end of the day. It's just kind of free flowing over time. So you're seeing these things come day by day.
Here's the biggest issue. The biggest issue is, when you have these prominent points of controls and poor lows and structure, is how do you trade from the long side? When the market's going up, that is a more difficult thing for me, because I know the potential to break, is there. I know the potential is there.
Right.
And so then, and that's another important thing, is just to understand how the market works. And part of that is, and it's also important to understand, we're traders. We're traders, nothing more than that. So when we go above a previous high, How many times have you seen it written, and we talked about it, that previous high now becomes support for the day time frame and the short-term traders. So we break above the old-time high, and this day does not come down to it. This day comes down almost exactly to it. This day, so you can just get this feeling mechanically, they're coming back to the 2119 level time after time again in there. And so, okay, if they're not taking it through, where are they going to go? You can say they're going to take it higher. Now, these aren't particularly fun days for me to trade. They're not particularly fun days for me to trade. But I also know I'm not going to fade these days. I'm not going to fade these days unless I'm awfully sure we're late in the game. And like I say, I didn't put my fade on until the short on, until I saw Friday, the way Friday was trading. And it's not normally what we see going in the weekend. I didn't like the market. I just said I would take the chance.
All right, you didn't have completion.
This is a bigger problem. You know, how do you survive on this when you know the potential for this market to break? And there's a lot of these days when I end up doing nothing. There's a lot of these days when I just sit there, and they're long, very long days, because I don't get involved in the market. It's not interesting me, and I don't think the risk reward is right for me. And that makes trading very, very long and tedious sometimes. Okay, a couple more questions.
Excuse me. It's also the hallmark of a professional trader, as you say, or our maturity as traders, where we can see a trade, it may work, it may be correct, but you just pass on it because it doesn't meet your criteria, and you're okay with not getting every trade, rather just waiting, and live to fight another day. So, I mean, I've seen this with traders that are successful over and over. They don't have to be compelled on every day to take trades that they just frankly don't feel that good about. They're okay, but they're just not compelled. Is 2119 a level that you're still carrying forward, or has it lost its relevance now that we've come through it again?
That's a great question, because we just said get rid of the reference, but no, it is still a reference that I am carrying, because we looked above it today, and it's pretty thin underneath it. So yes, I must admit I'm still carrying it, although from the way I answered the question earlier, I would say no. But yes, I am still carrying that reference to some degree.
Well, and I think, yeah, it is. And I think that on a daily bar, it certainly has its reference because it's a more significant reference. We're back inside this bracket at the top of this 5-day, or 4-day, 3-day, whatever you want to call it, balance up there.
Yeah.
So, but on profile structure, poor lows taken out, prominent points of control repaired, anomalies being revisited or repaired. That's a little different scenario, and they are knocked off the board. But this is a day, if we were looking at a daily bar, we'd see the relevance. So it's a little, I don't think we answered it incorrectly, or we're changing the rules.
Yeah, well, this would be,
it's different.
When you look in here, you get accepted or rejected in there. We got accepted today, but if we get rejected out of this 4-day balance or 5-day balance, whatever you want to call it, we get rejected out of that. I was using the 2119. If we get rejected out of that, then we looked into this upper distribution that Julia just mentioned, and we got kicked out of it. We get kicked out of it. Now the destination trade becomes another trade to the downside. And we'll talk more about that when we get to today or yesterday.
Excuse me, and interestingly, we pretty much one time frame higher most of the day. End period was a pullback low from that, I would imagine, although that's in the runoff, but that may be a fulcrum for you tomorrow, Jim, that, we should hold above the 120.
I'll get to today.
I
want to cover.
Okay, very well.
I want to cover yesterday next. If we're ready to move on to yesterday.
Hold on. If there is an untouched point of control, and these have to be prominent, that is at any relative distance from current prices, would that make the POC relatively unimportant or not factored into the current day's setup considerations?
I'm sorry, one more time.
if a point of control is relatively, a little ways away from current price activity, are we carrying it forward? If you look lower on Jim's
Absolutely.
chart, look at the Wednesday, look at
Look
that.
right here. Look at
Yeah.
right there. I was carrying, that was on the chart. I was definitely carrying that forward.
And the one below that too, we didn't quite
Yep.
get there
The
on
anomaly.
Friday, and
The
even below
anomaly.
that,
Yep.
from
Yep.
yesterday's action, we
Well,
went
and all
one
that stuff,
high.
all that stuff got corrected yesterday.
Yeah, the point of control though from the Fed day, I'm saying, if you move your chart over to the right, you can see it. Where we went yesterday. Okay,
Oh,
we
here,
got
yeah,
it. But yeah, it was, so
yeah.
they're definitely, but it's prominent or very prominent. We're not talking about any old
This one,
six-wide POC.
this is very prominent. This is prominent. Don't ask me why. I mean, they just look a little different. This one kind of sticks out like a sore thumb. I'd call this very prominent, call this prominent. But I'm not gonna split hairs over, one tick or two tick difference. It's looking at the entire shape of the market.
And yeah.
Okay. Can I move on to
One more,
yesterday?
yes, one question, do points of control, do POCs always need to be revisited? If not, then if a point of control is not revisited, how long will you give it before you decide it is no longer relevant?
A regular point of control, we don't worry about. It's only the ones that are, very prominent and prominent. And, I carry those forward until such time as, the market just clearly makes some new change in trend. And say, okay, we've got a change in trend and the market's off and running. And you'll see that on the weekly and monthly bar charts. So that's really the answer. But right now, everything we've seen recently is in this very confined area. For example, I'm still carrying this point of control from Friday. Wasn't revisited. And that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's a very prominent point of control. That hasn't been revisited. So that's still carrying forward. The fact that I have no real excess on the highs being carried forward. The fact that I've got the all-time high made in the over-the-counter market. I'm carrying that in the electronic market. I'm carrying that information forward. There's always conflicting information. And to some traders, that brings them to a standstill. You have to learn to live with this. Anytime there's no conflicting information, it is highly unlikely that you have a good opportunity. If there's no conflicting information, the opportunities are probably long gone. It's the conflicting information sometimes that allows you to have an opportunity. If you can, dig out the opportunity hidden within some of the ambiguity of, pros and cons. Okay. Let me go to yesterday.
Okay.
Yesterday was very important because, and I also, when we do that, I'm going to want to cover some of the chat comments that I put out yesterday. For those that are in the intensive, you're getting the chat comments throughout the day. So we already said yesterday, you had the written reports, the recap and preparation report, as well as the update in the morning report, all identified the 2119 level as a go, no-go level. So there's nothing cherry-picked about that. The market started to the downside. Now, once the market starts to the downside, now you're trading that day, but you're also making some kind of estimate about what do you think the success of that auction is? What is the market trying to do, and how good a job is it doing of what it's trying to do? Here's some of the chats that I wrote yesterday. This is at 9:19, so this would have been 11 minutes before we opened. The go, no-go levels, 2119, still there. 5 minutes before we opened, with just a few minutes prior to the opening, the last trade was 2118.50 with our major short-term reference at 2119. If we trade above the 2119, then Friday's low at 2123 becomes into play. Fairly defined acceptance below 2119 level shifts our focus to the overnight low at 2115.25. That's just taking it one step at a time. Then a minute before, I just reminded everybody there's heavy economic releases coming out at 10 p.m. 9:34, 4 minutes after the opening, if the overnight low is taken, the next downside reference is 2113.25. So this is just 4 minutes after we've looked above the 19 level, and now immediately we're focused on the next reference, trying to take it just a day at a time, and at that one reference at a time. And then we said then the downside reference 2113.25, and they said that would be followed by 2110.50. Okay, those were the chat comments that we were looking at yesterday. Somebody asked me why I selected 2110.50 as the next reference. If you look right here, 2110.50, this kind of anomaly right here as the market was breaking, and my answer was back to go look at the profile from 514. There's an anomaly at 2110.50. It splits the upper and lower distributions, and you just see that this kind of is a natural distribution between these two. So that was my next reference yesterday. So as this market's going down yesterday morning, as this market's going down yesterday morning, I'm trying to track it a reference at a time. Now, then at 10:03, so the market's been open 33 minutes. I write the first half-hour volume at 385 suggests liquidation rather than a more potent combination of new money selling and liquidation this morning. Right now, I'm 33 minutes into yesterday's market. The market is dropping like a rock, and you've got a chat comment going out there that's saying caution at that point in time. That's the first caution, saying look at the volume, 385. That is not particularly strong volume for the distance that market covered yesterday. So I'm looking at, and that's an early alert that we're more than likely seeing old business, which is liquidation, rather than a combination of old business and new business. You put the trade on, you monitor for continuation, and you're trying to have some idea of what could happen here. So it's moving pretty quickly. There's a lot at stake, and you're trying to process information. So 33 minutes into the market, I've issued the first warning because of the volume in there. Then I write later on 2103.50 remains my next downside target, and 2103.50 would have been right here. If you see, this was the next downside target because that was a poor low. There was no excess. So you can see I'm just knocking these references off one at a time, and you can pretty well guess that 2096.50 is because it's a very prominent point of control. Very visual type of references as this market went down. Okay, so now then at 10:22, so the market's open about 45 minutes. I write this market is very strung out on the downside relative to the volume. It appears that some balancing may be called for. This is strictly an odds thought. It's strictly just an odds thought, no other information than that. But I'm looking at all the single prints coming down here, and this is the first half hour. So 45 minutes later, we're someplace down in here, and that's the comment. It just seems to be too strung out. 10:37. Since we took out the 2103.50 low by a single print, so we took this out by a single print, and I said, okay, it has been repaired. So we reached that objective. Now this is important if you're doing day time frame trading. It has been repaired. Now today's low is good, single print buying tail, but weak because it is only a single tick below the old 2103.50 low. If anybody's got any question what I'm talking about right here, the market made this objective and it got out this poor low at 2103.50. The market then bounced and we left a single tick buying tail in C period here. So you say, oh, well, it's a good low because you've got a single tick buying tail. But I'm saying, no, it's a weak low because it's just a single tick below this low. So any question what I mean by a good low? At the same time, it's a weak low. So this is what going through yesterday so far. Any question on what I just talked about? Anything there, Julia? Julia,
Hi,
we still on?
Yeah,
oh,
thanks.
Okay.
Why do you use targets like that and not just use a trailing stop?
A trailing stop is a whole different. A trailing stop has nothing to do with these references. Those are totally different concepts. The reference, I'm looking at logical places where the market may be headed. And you see that's happened time and time again. We click these off, and like this was the one, and it went one tick below it. Obviously, it was a good reference. Now, a trailing stop to me is not my way of trading because a trailing stop is generally a mechanical type of thing. It's a money stop. I just don't, it's not something I do. If I was going to use a stop like that, I would want it to go back someplace where it violated structure on the upside. It would need to violate some structure on the upside, need to stop one time framing or something of that nature. But those are not related concepts. There's, I'm looking and saying, markets are very visual the way they trade. And as we say, we were calling out these references yesterday, and this was the next reference. And look at this reference down here. It was another reference. Market ended up going 2 ticks below it. It's how do I map out where I'm going and how I'm doing by using these references. Okay, go ahead. But any questions on the weak low and the poor low? Because those are very important concepts, because with the idea of the weak low being that early in the morning, the odds are pretty good that we're going to come back down and take that out. That's why I put it on the chat comment that it was a weak low.
Yes,
okay?
And because you had the momentum, it's a different context, but that's on the Signature Trades worksheet too, that likely you get a bounce off it, it's coming back at it, particularly on this type of market situation. And again, Jim, if you would be, why does he want the map? Heath, I'm not understanding. Jim doesn't use a trailing stop. And I know you're in the intensive, so you're going to have plenty of opportunity to get familiar, but he's using references from the profiles to monitor his trade. He's not using a money stop or a trailing stop. I guess it's personal preference. I don't care. Then re-ask your question, because I'm not understanding. Again, why does he want the map? I have no idea what that means. Jim talks about good highs, lows having a minimum of 2 ticks beyond next period marks. As the price moves through his suggested targets, is there a similar 2-tick move through the suggested target to know that the moves will continue in the current direction?
Well, it certainly helps. This one went through 1 tick. That lessens the odds that it's going to hold there. You know, if it went through 4 or 5 ticks and came back, now you got to wait and let it play out a little bit more. But when this was a weak low, even 2 ticks would be questionable in the way the market broke yesterday.
You'd want to see a little more aggressive, like buying to push it back up. It would be, you want more excess.
Particularly that time in the morning, because we're going to see later in the day, that we had a poor low before the day was over yesterday, and we're going to talk about that. But okay, let's go forward.
One other question. What number would be a lot of volume? Volume, and because Brian, you're in the intensive, you can look at the volume at the intensive site over the last, I think it's 30 days. So we're really looking at over the last couple of days. You can download that spreadsheet from 2003 on every 30-minute period, and you can get a more historical sense when we were breaking in 2008, and in March 2009 you'll see some serious liquid, unwinding from positions. But we're just, lately we're in summer hour time now. It's if it was under 3 yesterday, Jim would have said, "Wow, really?" Or Friday, if it was under 3, that would be really low. But
yesterday was 385 on the half hour.
3.85 billion.
So we talk about
yes.
I'm sorry. We talk about the half-hour periods, then we talk about the total day. I'm generally looking at the last 10 days or so because I want to be. What I don't do is go out and do an average of over months and years of it to get it. That's worthless to me. I want to know what's happening nearby. For example, I know yesterday was 385. I just know from looking at this stuff that if there's anything really serious going on, we're going to be sometimes in the 480 to 500 range.
Yeah.
I mean, you really get some good vibe. But we're 385 yesterday. This morning, I think we were 405. So we were up 20,000 today over yesterday. And this
is all
30-minute
period.
First 30-minute period.
So you get a sense, and you have that at the training site. So just keep an eye on it. You start looking at it over a couple of weeks, and you'll get a feel for it. Here's a good question: with the excess created on May 26th, now obviously he's talking about daily excess because we have a poor low on the profile, but a daily bar, you can envision that 526 being excess. Was the excess created on May 26, quote, weak because of the low volume?
There's all type of things involved. One, remember I started off and I said we started yesterday from a single tick above the 2119 reference. That was one of the first things I mentioned in here. And if I really thought the market's not going to wait to such an exact level if there's really new longer-term selling in it, more than likely. So that was one of the things that I marked. Remember, I mentioned that as soon as we started today, that the fact that we came from a single one, you have 2 time frames involved. Yesterday, we were so focused on the 2119. Go with that trade. Go with that trade. That's our number. We're down below it. All of those days above it, they're all underwater. But then I take a second breath and I say, because it came from one single tick, 1/4 of a point from the reference, I'm already carrying forward that was not a particularly good high yesterday. Okay, I'm already carrying that information forward. Then I put together, I had 385,000 on the first half hour. Okay, so I got 2 pieces of information in there that says, wait a minute, that's not the best of, that's not, you saw the one chat I put, I said, this looks like a liquidation rather than a combination of liquidation and new money selling. Okay, now, then, and this becomes into feel. And as this market got down here, remember it was stretched out. I thought it was too stretched out. I thought the volume was low, and at 11 o'clock I wrote, I've made a personal decision based upon what I feel are the odds for the downside continuation. Well, I doubt the lows are in for today. Based upon volume and how strung out the market is, I have closed out my shorts, at least for now. I'm going to take a walk for 30 minutes and then come back and take a fresh look at the market. These are artful decisions. Now, they're not blind emotional decisions. Remember, I didn't like the volume and I didn't like the high. When the markets got down in this area, 11 o'clock would be, let's see, an hour and a half into the market, right?
Could you expand that profile, Jim, so we can see the 30-minute bars? It would be helpful just to see it as, thanks.
Okay, so A, B, C. So this would be in this period right here is where I said at that point in time, based on the information I just talked about, I closed out someplace in there, I closed out my short positions, and I said, I'll come back, I'll take a look at it later, but I'm going to step away for 30 minutes. Okay, now that's simply based upon the exactness of the high, the volume, and just feeling to me like it went too far, too fast.
And it did end up snapping back, but it was a rally. It stopped one time framing, then they went back at the lows again. But it didn't, it wasn't killer. One question here. In this morning's report, Jim stated that poor lows occur when the market is too short. Can you explain that? So while we're looking at it, you see the poor low there.
I will, but I'm not there yet. I'm not to yesterday's low yet. No, I'm definitely going to talk about that.
Okay.
Okay. So now, the market then also, there was another chat comment that went out yesterday, and 2104.50. When the market started to, do spend some time. Remember when I left, I said the market felt to me like it was going to need to balance in there. And then at 11:56, I wrote 4 wide at 2104.50. This is consistent with my comments before I took a walk. Markets are always searching for a level where two-sided trade can take place. 2104 is the heart of that effort. Okay? Remember, markets don't go down forever, they don't go up forever. They're always searching for some kind of level where two-sided trade can take place. And we hung around that 2104 period. We were there for 1, 2, 3, 4, 5, 6. So we spent 3 hours around that 2104.50 level. And the market got 1, 2, 3, 4, 5, 6 wide there. So again, what alerted me to, where did I come up? The question is, where did I come up with the number of 2104.50? Did I pull it out of the air? No. 1 wide in B period. 2104.50 is 1 wide in B period, 2 wide in C period, 3 wide in D period, 4 wide in E period. So as it gets 4 wide, that's how I use structure. Structure starts to tell me, how well the market's doing, and it's okay. It's looking for a place where two-sided trade can take place, and we spent about 3 hours around there.
And that, Jim, too, was the point of control. That's what those gold letters signify. That at the time of those bars printing, D period, the high there, that gold that Jim's pointing to, that was a point of control. Then E came on, point of control, F. And you can see in G period, it dropped lower. Or actually G, it's gold there too, I think. But it was rotating. It was widening out. So it was showing two-sided trade occurring, kind of like it was over.
Okay, now I want to show something else. We saw this again today. The market stopped one time framing in the 4th period. It is not unusual for a market on a trend day, usually it's later in the day, but it's not unusual for to stop one time framing one time to allow inventory to come into balance. At this point in time, that's exactly what the inventory was coming into balance. Now, as the market broke later, remember, before this market broke, we were 1, 2, 3, 4, 5. We were 6 wide here. The point of control did drop. It did drop. We got 6 wide. It didn't drop. I'm sorry. It didn't drop. It had the potential to drop. And then the market continued lower. Okay, now, let me see here. Okay, and I wrote here, if it gets a little trickier at that point, to watch and see if the point of control drops. So I'm watching. The point of control is 2104.50. It could lower down here to 2103, which would be significant. And then the market broke. And I said, if the POC isn't lower, the odds either favor more balancing or a rally. 139, I wrote, technically the POC didn't go lower. I should have communicated better. I should have said, if they don't print at 2104.50, then the odds of lowering the POC have increased. But at that point in time, this was a touch and go. I didn't know if we were going to be able to hold this lower POC, lower this or not. As it turned out, it didn't. Now, at 1:48 Eastern Time, I wrote, I think we are in the process of getting too short. Remember, it doesn't have to be a single event. So at that point in time, I was watching this. I was watching the volume. I was watching the rotation, and I see how wide this is getting. And that's why I put out the comment yesterday that it looked to me like the market was getting too short in there. When the market breaks down to this level, if the point of control doesn't drop, remember the point of control is still up here. Okay, now I'm going to bring this back together for a second. I'm sorry, I'm forgetting. How do I split off just this day, Julia?
You mean hold the shift key down and double click on the period that you want to split.
Okay.
Thanks.
All right, now notice as this market's breaking lower, POC still up in here. This is, do you see the 45-degree angle developing in here? Remember, I wrote it appeared the market may be getting too short. This POC, I was watching this POC very, very closely. But notice as this market continues to break,
it's not migrating lower.
Okay, I was trying to.
You can cancel that, Jim.
Okay.
Cancel that split. Okay,
no,
there
that's
you go.
Okay. I wanted to see what it looked like before L period. This is the point of control up here, and it's coming lower. Now, what's happening when you're looking as a trader, if you're not careful, you get mesmerized by price, and you get mesmerized by price going lower. The rotation, I'm going to split this whole thing out here for a second. The rotation down here, pretty good, low, up, and at this point in time, with the point of control staying up here, that's what led me to write that. It looked to me like the market was in the process of getting itself too short. I don't know that. We don't know that till after the fact. Now, let's go on and talk about the poor low from yesterday. Let's collapse this. Now we go down and we talk about the poor low, okay? And we've written on numerous occasions that poor lows and poor highs can be indications of markets that have gotten too long or too short. That is something I've learned by observation over the years. Think about it this way. If a market gets too short and all of a sudden it goes back down, there are traders that are short and feeling nervous. They're so anxious as soon as they get that price, oh my golly, that's what a great price, and they're covering just to get the pressure off. So that happens. That can be an indication that a market is too short. It is also an indication that from the next time frame, it's not a good low, because when the market makes a poor low because it's too short, it was old business, people covering shorts more than likely, that made it a poor low. It wasn't like it had new business that drove it out of there very quickly. If new business drove it out of there very quickly, you'd be more than likely to have single prints. So this is a good low for then, but more than likely, it's not a good low going forward. Now, it doesn't have to be the next day. Remember, we looked at a poor low over here, and we saw that was taken out a few days later yesterday. So again, information you need to carry forward. So now when we go through this, that's an analysis of yesterday. But remember, we were 33 minutes into the morning when I first cautioned about the volume in there and started to look and say, what do we really have here? Do we have anything more than liquidation? Remember, what you're really always looking to see, liquidation is old business. And sometimes a market has to break before it can rally. Okay, so we had a poor low. Now let's go in and talk about what did we write up last night. When you look at last night's report, the number I selected last night was 2107.75. Now, I think I put on the report someplace why was that an important level? Julia called me last night and asked me about it. She said, well, wouldn't it be E period, the rally high, or maybe even N period? I said it could be. This was, there's all single prints above this, which I use the single prints as identify one distribution from another. I didn't count this as a double distribution day, but I'm looking at all the activity that took place down here. Remember, at the end of the day, I thought the market was too short. So that's one where I'm coming at. Thought the market was too short. Although my personal position at that time was neutral. A combination of the poor low, I had a breakout to the downside, I had a gap, I thought the market was too short. I could argue either side for today fairly evenly. So my position was neutral. But I wrote up, if the market starts to find acceptance above the 2107.25 level, then I think that we've got a short squeeze. I don't remember the exact language in there. I'm looking to see if it's...
You said that if they get below I said, okay, it's a single print. You said if it gets above the C period, all that selling, they're all going to be underwater. I think that's what you wrote. That's
what I was trying to see. Here's what I wrote in the perspective going forward. This was the perspective for today going forward. The all-time high still occurred in the electronic market. It would be unusual for the long-term auction to end in this manner. So that was part of the perspective for today's report. Tuesday delivered the traditional B formation. This formation suggests long liquidation rather than the more potent combination of long liquidation and new money selling. See profile below. So that's in the perspective. And third, I'm using the lower distribution with the loop of the B formation as my reference. I see the loop as a separate day or auction. Okay? So now...
And
let's
Jim,
go back.
if I may, everyone, you have access to these reports for people that came in after. You might have heard it. You can go to the webinar post at jdaltontrading.com, resources, webinars, upcoming webinars, and these reports and all, they're all there for you if you want to download them along with the slides. Excuse me, Jim. Go ahead.
Okay. Now I want to go back and I want to talk about the fast track document again, because one of the first things in the fast track that we talk about, and for a definite reason, are we in balance or are we out of balance? So today, if I'm treating the lower loop as a separate day or auction, then when I trade above that lower loop, I am out of balance. So I opened and traded, I stayed within balance. Once I get back above the 2107.25 level, I am out of balance. Remember, on a double distribution day, I treat each day as a separate day or auction. Yesterday, I elected to treat this lower distribution as a separate day. So trading within this separate day keeps me in balance. Once I get above this day, I am out of balance. The biggest trading opportunities come when you are out of balance, not when you're in balance. When you're in balance, the market is generally choppier. You have usually smaller opportunities. When you're out of balance, the opportunities generally become much larger. We were out of balance once we started trade above the 2107.25 level. Now, but the reason, as I was talking to Julia last night, the reason that I wrote it this way was that you know, the majority of yesterday's selling took place below the 2107 level. And remember, yesterday afternoon, they're selling it all the way down. So all these people are short. What I want you to feel in here, this is how you prepare yourself to compete. Yesterday morning, once the market started down, traders were immediately selling all rallies. Not blind, they're just blindly doing that. So when I call attention early on that the volume wasn't there and the high was questionable, now I'm already having in my mind knowing that the traders, the short-term traders that are just automatically going to sell all rallies all day may get themselves in a lot of trouble. Guess what? They got themselves in a lot of trouble. They were selling this all yesterday afternoon, every time. Let's split it out one more time. Okay, so what are the traders? They're selling the rally, selling down here, and they're getting short in the hole or short at very poor prices. Remember, we also had the 45-degree line up here developing. So again, it's very difficult to trade because you're trading yesterday afternoon, you're seeing price go down. Every time it sticks its head up, you see it go down. You want to naturally do the same thing. And you don't think about how you may be getting yourself into trouble because you're doing what everybody else does. And it would be different. Let's say they were doing the same thing. Let's change the context. Let's say they were doing the same thing, but the context was different, that we had good volume. Let's say we had 480, 500,000 contracts the first half hour. Let's say we weren't exactly at the 2119 reference. We could change that context and say, wow, yesterday looked pretty good on the downside. So everything's a series of facts surrounded by other circumstances. And bringing in that information suggested this was short. This morning, the reason I wrote this up, I said we get above the C period at 2107.25. We get above that, the shorts are caught. And again, you know we're not cherry picking something to do a seminar here. You saw this information written up, and if I'm not mistaken, I think I even put a section in it that said, let me discuss the thinking in here. Here I wrote, the thinking behind this statement is that any selling that occurred following the third period high at 2107.75 would be underwater.
Quarter, yep.
And that's what was going on. So again, trading is tough. Now, somebody asked a question, and I said, let's hold that question. They were expecting the market to go lower today.
Before we do that, Jim, not to interrupt you, because that's great to get Ryan's question in, but if we can just look at this profile, if you slide it up a little bit, the gentleman's asking, does that therefore mean that all trades below yesterday's end period low have all now, make it a little larger, been caught short? It actually means not just the end period low, but really even, just
any selling below the 2107.25 level. All those people that went home short last night, they were in trouble this morning.
And look at the overnight; they couldn't even get down there again. You could feel it. But that's the great thing. I mean, Jim and I just happened to talk after market. I said, yeah, I got long at the end of the day because I just thought they got them too short. And you say, why would you fade one time framing? That doesn't make sense. Well, and Jim said, I did too. I said, oh, did you buy calls? I was wondering if you bought calls, what strikes you were looking at. And he said, no, actually, I bought outrights because I knew it was just going to be for the day. I didn't want to carry it home.
Yeah, and so, I went home. I said,
oh, okay, so you bought
neutral.
The
I went home neutral last night because I could argue both ways.
Yeah, but when you can pick those out and just, you don't have to be exact, but you just know they're in trouble or you feel like they are, it's really a nice trade. You can bag 6, 7, 8 points at the end of the day and in short order. It's not that hard to do once you pick it out, once you see it over and over.
Yeah, it gets harder with the poor low, but you have to understand the feeling coming. That's why I was going so much time to spend what was going on to lead up to this. And this is what too many times traders really don't want to think about that. They just want to look at price and trade based on price. And that's pretty hard to get an edge and do that. You need to have some understanding of what's underneath it.
It's like
Okay.
having a GPS. I mean, that point of control was telling you where you were, what was going on. You didn't have to get lost and turned around with the price going lower or lower. You could see that that rotation was just the point of control wasn't migrating lower. And what a great thing to lean on, and be thinking different than the pack. Because we know if we're following the pack, we're probably not going to be making a lot of money. It's a very lonely existence as a trader sometimes. But the point of control and structure, I think, it's a great tools to lean on and use. Okay.
You want to be, let's talk about being a contrarian. You don't want to be a contrarian when the major move is taking place. When yesterday's market starts to break down below the 21.19 level, you do not want to be a contrarian. You want to be with the herd. Where you want to be a contrarian is later on when the volume's not there and it looks like it's going to balance. At that point in time, now you shift your thinking. But you don't always want to be a contrarian, and you don't always want to be a momentum trader. You want to be a mixture of both. Okay, now go back, and somebody that was looking for this market to go lower and disappointed, yeah, I think we've walked through what we saw going down there that said, the odds of downside continuation weren't really good from yesterday. But if you're looking at remember, one poor low is a single data point. Now, I'm carrying this data point forward. But, and we may come back there, and I'm also very much aware that I've still got some stuff over here that hasn't been revisited. Okay? But, okay, now before we go into today, any questions on what we've covered so far?
Okay. If we missed the early entry yesterday, how can we know when to enter thereafter?
I don't know how to answer that question. You just have to do it. Remember when I said the market was, when it balanced? When it started to balance and it rallies up, you can sell the first rally.
The E period, if you could wait that long, or even the B period bounce there, you just got to get on it. It's not the thing about a trend day like this is you don't have trade location. You're not having a nice tidy reference to lean into and put it on. It's a gap and it's going, and it's more important to get on the trade, and as they say, than worrying about the trade location. Completely different mindset than a rotational reversion to the mean type trading day, which we normally find ourselves in.
But don't forget, we kept calling references yesterday. It said, okay, the overnight low. Then at one point we reached the prior low. We said, okay, now we have a good low. We have single prints today, but it's a weak low because it was one tick below the other low. You can sell that first bounce. That's another way to get in. You got a weak reference down there, sell the first bounce. But the big thing is to have yourself set up to understand what the potential is for each market. Okay, now today, I was the king of the world yesterday. I was just in touch. I'd been set up for it. Everything today was just a very, very long day for me, because I really didn't like, as you know, I was expecting a short covering rally once we got above the 2107 level, but as I put out, and I put it out for the benefit of all of you there to understand, what happens to us. I think I put out a chat this morning, and I said, I was still sitting on my hands, but I'd done mentally 3 trades in here this morning. I was long, short, long, and I just got myself, I didn't actually do the trade, but I had mentally done 3 trades. And, when it opened, and I thought, well, it'd probably go down to the point of control, and so I was mentally short, but then it came back too fast, and I had myself twisted around. And I put a chat out there. I've been, I've done 3 trades mentally. Somebody was very funny. They chatted, they sent an email back. They said, Jim, we decided you're over trading, which I thought was very funny. But then the confidence, because I was back and forth through this opening this morning, I got shaken out a bit because I didn't see the confidence in the market. As well as I wrote this market up, as well as I wrote it up and I had it identified, when the market started up, and I'm even though the first A period volume caught my attention, it was 405, it was higher than yesterday, but I thought that there was too many A period prints in here. I thought it was a short covering rally. I thought it was too many. Then we got the inside bar in B period. And the first thing I noticed that the market did not get back. I think I wrote that the overnight high was support. Okay. Okay. And the market came back just short of the overnight high. That to me was the first trade where you had at least some idea of where to put a stop. I'd like to say I took the trade. I didn't take the trade because I still thought there were too many single prints in here. You know, and I don't want to misrepresent that I wrote it up correctly. I wrote it up correctly, but that doesn't always mean we trade it perfectly. I got myself messed up early on. I suspect part of it was, and that's why I'm sharing with you, because I could do no wrong yesterday. And, you know, I was ready for the big kill today, and they kind of got me cross purposes here, even though I didn't trade. I went mentally 3 trades. And then this market just seemed too slow and too sluggish to me all day long. The first clue was when it stopped one time framing in G period. Early on, I had written that if there was anything on the downside, it needed to stop one time framing and go back and take out the single prints here. But remember, at the time it did that, we had a poor high. Then it came down, and one of the chat comments I put out is I don't remember the wording, but be cautious, because on a trend day, it's not uncommon to have the market stop one time framing one time for inventory to come back into balance. And inventory, you know, came into balance, and there was no selling on the market. That's all there was. Then it was very quiet. F period was what, only 7 wide? G was very wide. Finally, H breaks out, and then I period goes for 5 ticks. 5 ticks Y in I period. Up there. So this was not a day for me. I just I was wanting to know if anybody had the pill for the deer in the headlight in there. It was such a grinding day, and the volume kept declining all day long. So again, I would like to show you how neatly I traded this day, but I basically sat on my hands for most of the day. Now, I did, and again, and I'll share this with you. 1, 2, 3, 4, 5, 6, 7 anomalies. When this market made this last run right up here, I bought 2120 puts. I went home long, 2120 puts. I paid from 435 to 490 for them. So, I mean, that was my position going home, and the reason for that was the number of anomalies. 1, 2, 3, 4, 5, 6, 7 anomalies. Almost always, when I've seen this many anomalies, it's because the market has been in forcing action. Meaning, what is forcing action? Short covering is a form of forcing action. In other words, it was old business, not new business. I went up and I checked the volume. We're going to go do that here in just a second. I'm going to our site. For those that are in the intensive, there's the NYSE volume. And then, as you can see, all day long, the market's going higher, and this is the delta. It's decreasing volume all the way. When prices go higher on decreasing volume, that is usually not a positive going forward. The total for the volume as the day ended was 3,000,000,001. I think yesterday was 3,2 or 3,3. That's exceptionally low volume for the distance covered. So now, what have I done? I've done a tactical, what I would call a tactical trade in there. And I may not be around a long time. I got fairly lucky on the execution, but I looked at all those anomalies, and it's so rare that we have those anomalies that aren't retraced, or at least several of them retraced the following day. So I did a combination today. I think today was short covering or forcing action. Structure was terrible because of all the anomalies. No new business because volume was less than yesterday, and it was drying up on every half-hour period. So I made a decision late in the day as it made its last run to the upside. I made a decision as a tactical trade to go home with puts. And like I say, they're the 21-20 puts. So that's where I am for tomorrow. I mean, now, I got back into this area, and I still don't have a good high up here. So, you know, I'm not going to be in love with this one way or the other. That was just a decision I made at the last moment. Okay, questions?
Let me see, Jim. This is someone in the intensive. He just emailed us. I made the same trade that you did with the puts, except mine were the 21-25 puts. So.
Oh, you're brave. I wanted the leverage.
Yeah, so he paid a little more, and you know, I don't know. You'll see tomorrow. Maybe yours work out better. They don't always, they're not linear. So sometimes closer to the money, get a little more bang for your buck when it gets down there.
Well, the thing is, just so you know, and I'm not trying to sell you on doing options because there's other complications with them. I don't use any of the Greek numbers, but once I get in the options, I could buy futures. I could go buy 50% futures against those right now if I wanted, depending on what the market does. I can just leave them. There's all kinds of things I can do with them. But the main thing is my read of the market on the upside today was terrible. Based on the anomalies, 7 of them, based on declining volume. I mean, if I lose on the trade, I lose. But this is how I look at a market, and this is how I look at it from an odds standpoint. From an odds standpoint, I think there's good chance that we're going to retrace part of today. If we don't, I lose, or I have to scramble and get long against some of the puts. But that's how I read the market. It was like I say, it was a very long day for me. It started poorly because I got myself mentally out of shape early this morning. I didn't think the conference, or I thought there was too many single prints, and those things happen to us, folks. Somebody, when I wrote that comment, somebody sent an email, said, "Does that still happen to you after all you've been trying?" I said, "Absolutely, it happens. We're all human, and anybody that thinks that you've got it all figured out, be very careful. The minute you think you've got it all figured out, we're going to come and get you." There's good days and bad days. Today was just a very long day to sit. If I hadn't been doing the chat comment, I'd have been long gone. But anyhow, okay, a couple additional questions. We're running very late.
Yes, thanks, Jim. Does Jim look at the single print in H period the same as the other anomalies?
Well, I didn't count it. I counted right here as an anomaly.
Make that a little larger, Jim. Just pardon me. I don't mean to interrupt, but just thanks.
This area right here, I called it an anomaly. 1, 2, 3, 4, 5. I did not count the single print. 6, 7. I counted as 7 anomalies. But I don't have any objection if you call the single print an anomaly. The single print will be a reference for me. If there's anything going here, I need to get back down below that single print. When I think I put something out earlier this afternoon, if there's anything on the downside, we would see a print at 21-17-25, and we never got that print. But that was a reference I was using this afternoon when I put the chat comments. Okay?
Okay, and where can I get the half-hourly volume? I'm going to type it in for all to see. You can go to Yahoo, and I'll put the symbol in for you, and you can just check it, record it. We're trying to get it on the member site. A trader's doing it for us out of the goodness of his heart for everyone. And he's had some family stuff going on, but he's going to put it on our member site for you as well. But I don't know when that's going to be. What option product and expiration do you usually trade when you trade options? Usually the weeklies and E-mini S&P.
Yeah,
Futures.
I usually use the shortest ones I can find. And so this was the ones that they expire. They're the month end of month options that go out this Friday.
Is the 2118 reference, is that going to be important to you for tomorrow, Jim? Is that a major reference for you?
2118?
Yeah. I don't know why.
Well,
maybe if you
the
move it
single
over to the
prints.
right. Yeah.
The single prints. I guess, yeah, it's 21. Yeah, the single print. I mean, if there's anything on the downside, I want to see the market print 21.1725. I want to see all of this underwater, and I want to get back down into this, below this last upper distribution today.
Okay. I sent that volume figure out, that volume symbol for Yahoo. You should have it, everyone. What are the three? We have to head. I really got to get going here, but what are the three expectations, or maybe we should say scenarios, going into tomorrow, Jim?
Well, scenario one, which is really a couple scenarios. If you take this lower distribution, I'm going to call this a separate day or auction.
Above the single print?
Yeah.
Okay.
So one scenario would be above this. Two scenarios would be below it. It's probably too narrow to remain within it. So one scenario, my important scenario would be above it. Next scenario would be below it because it's fairly narrow. So we're going to do one or the other. So I'm going to treat this as kind of a small balance area, as a go, no-go level here, a go, no-go level here. That's what will comprise most of my early scenarios for tomorrow. Okay?
Okay. Excellent, Jim. Thank you. Okay, everyone. We're going to we need to wrap this up. Thank you, everyone, for being here. If you're contemplating the intensive, you still have time. We start on Monday. We'll go for 5 weeks, and it'll be pretty full throttle. But by the time July 2nd rolls around, you will definitely have a much better sense of this thought process and how to monitor your trades, profile structure, getting too long, too short, overnight inventory trades, a full gamut. So if you're interested, you're welcome to give us a call. And if you're not going to continue on, we thank you very much for being here. This is our last public webinar, so we can focus our attention on the intensive. But it's been great having you all, and we've gotten some phenomenal questions, and people are very interested and very engaged and really picking up on it. So thank you, everyone. It's great to have the questions along with it. And thank you, Mr. Dalton. We very much appreciate it.
Thank you. Drive safely.
Bye. I shall. All right. Thanks, Jim. Thanks, everyone. Have a great night. God be with you. Bye-bye.